At the end of the last part, we learned that investing is not about speed or excitement. It is about understanding what you own, why you own it, and how it fits into your long-term goals. Now we move into the next step of the journey, understanding how money actually grows over time. This is part 3, how money grows over time. To understand growth, we first need to understand what happens to money once it is invested. When you invest money, you are putting it into companies, products, or services. Your money is no longer sitting still. It is being used to build businesses, create products, and provide services to people around the world. As these businesses grow, your investment has the potential to grow with them. However, growth does not happen in a straight line. Day to day, prices move up and down. This is normal. Markets change constantly based on news, expectations, and emotions. One day prices rise. The next day they fall. These short-term movements can feel confusing or even scary, especially for beginners. But these daily changes are not the main story of investing. The most important idea to understand is this: time in the market beats timing the market. This means that staying invested for a long time is usually more important than trying to guess the perfect moment to buy or sell. The longer your money stays invested, the more time it has to grow. Historically, the stock market has experienced drops, crashes, and crises. But over long periods of time, it has recovered from those drops and continued to grow. This is why time matters so much. When investors panic and sell during market drops, they often lock in losses. Long-term investors understand that drops are temporary, while growth happens over years and decades. They stay invested and allow time to work in their favor. Think of investing like planting a tree. You do not plant a seed and expect a tree the next day. At first, growth is slow and sometimes invisible. Some days it rains, some days it storms, and some days nothing seems to happen at all. But over time, the tree grows taller and stronger. Investing works the same way. The key lesson here is patience. Money grows over time not because prices go up every day, but because growth compounds and markets recover. Short-term drops are part of the journey, not the end of it. Now let's look at one of the most powerful ideas in investing: compounding. Compounding means that your money earns returns, and then those returns begin to earn returns of their own. Over time, this creates growth on top of growth. This is how small amounts of money can turn into much larger amounts when given enough time. Let's walk through a simple example. Imagine you invest $100. In the first year, your investment grows to $108. That is a gain of $8. In the second year, your money grows again. But now it is not growing from $100. It is growing from $108. Over time, this difference becomes significant. In year 3, your investment might grow to $106. In year 5, it could be $140. In year 10, it could reach close to $200. The exact numbers can change because markets go up and down, but the pattern stays the same. Growth builds on previous growth. This is compounding.